Okay, folks, welcome to the new decade, the new year, 2020. Man, I gotta tell you, as a child of the 70s growing up, watching cartoons like the Jetsons and all of these futuristic shows, to me, it's amazing to see this time and age. 2020, I mean, really think about that for a second. I mean, we're really in what was, in my day, the Buck Rogers years. You know what I mean? If anybody is from the 70s in the U.S., you know what I'm talking about. But anyway, I just wanted to wish you all a very happy New Year. I hope your holidays were pleasant. Mine were absolutely wonderful. Thank you for all your warm wishes by email. And kind of like going to get into this, I want to keep it brief. We do a slow start or soft start to the new year every year, and usually my activity level is pretty much non-existent until the first trading day of February. I used to do about mid-January, but I just seen a lot of, I guess, inconsistencies with the delivery of price. And now that might not be the case this year because, as you know, last night the news broke that Trump authorized a hit on an Iranian official, and we're probably going to have a lot of backlash as a result of that. So that's going to cause the markets to churn. It got a little bit of excitement for the crude oil market, which we're not going to talk about tonight, but just know that these types of events, whenever there's a geopolitical event or an election or a war or a terrorist attack or a earthquake or something of that nature, it will usually cause some kind of shockwave in the marketplace. War tends to be a little bit longer term impact versus the other things I just mentioned. All right, so again, this is our first review and commentary for 2020, and again, I'll keep it brief. All through this month, I'm going to try to keep them very, very brief. I don't want to try to take too much time and lead you to believe there's a whole lot to do in the marketplace. This is a month where you're going to be doing a lot of note-taking and screen capturing and annotations. Okay, you're not going to be doing a lot of engagements. If you do, just understand that you're doing it in a time when the markets are establishing a bias, they're establishing a sentiment, and generally whatever happens in January is not always indicative of what you see transpire for the rest of the year. Think of January as like an Asian range. And if the whole calendar month, January to December, think of January as the beginning of the Asian range where accumulation is underway. Okay, and we try not to forecast a whole lot. I know Larry Williams, he does these things every year where he kind of like forecasts major moves and such. I don't think it's something that should be done at the beginning of the year in January. At least in my personal experience, there are times within the first 3 months that you can do that, or I can do that rather, but I want January behind me. Okay, so anyone that's gone far enough into the mentorship that understands IPTA data ranges, the lowest data range, and the 3 that I teach, that's what I'm waiting for. Okay, I wait for that to kind of like build in price action throughout the month of January, and then I have something I can trust a little bit more than just going in there, rolling the dice on just because a new calendar year has begun. There's a lot of holiday volume that needs to be ironed out, and that's typically why I sit on my hands through the month of January. That does not mean that I won't have an opinion and I won't share them with you each week. It just means that I personally won't be actively engaging until the first trading day of February. Okay? All right, so here's our economic calendar for the coming week and Monday, January 6th, 8:30 a.m. New York. We have Canadian dollar, RMPI, medium impact. Tuesday, January 7th, 5:30 a.m., Euro-dollar medium impact CBI flash estimate, and 8:30 a.m., Canadian dollar medium impact trade balance. 10 a.m., high impact dollar ISM non-manufacturing PMI, and 7:30 p.m. Australian dollar high impact building approvals. Wednesday, 8:15 a.m., New York session, high impact ADP non-farm employment change. 10:30 a.m., medium impact crude oil inventories. That's going to be something you can watch for Canadian dollar as a bread and butter type setup. Low resistance liquidity runs. 7:30 p.m. Australian dollar high impact trade balance. Thursday, January 9th, 8 a.m. New York session, medium impact FOMC member speaker. And that's an odd time, isn't it? 1:01 p.m. medium impact 30-year bond auction. 2 p.m. Canadian dollar high impact Bank of Canada speaker, and Australian dollar high impact 7:30 p.m. Thursday retail sales. 8:30 a.m. Canadian dollar high impact employment change, unemployment rate, dollar high impact average hourly earnings, high impact non-farm employment change, and unemployment rate for the dollar. So we have the Canadian dollar, Australian dollar, Euro dollar, and GBP with the dollar as my filter. If I wouldn't have included Canadian dollar and Aussie dollar, the economic calendar would have been even more sparse than it is here. Okay, so I tossed it in there just for completeness sake, also to fluff up that calendar for the coming week, give us some more talking points. Okay, so the dollar index is our daily chart here, and lo and behold, all right, just a couple things I want to go over. We have the 2018 high, and we return back to that. And look at this on Christmas. Okay, this occurred on Christmas. The market dropped down, swept below this low here, and came all the way back up. These are the types of things happen in the holidays. Now, I don't want to be caught in something like that. And I have had something like that occur to me when I was in Thanksgiving, I think it was. Yeah. Thanksgiving, I was doing some trading, and the market just blitzed me. I just had no chance of getting out, and it hurt me pretty bad. So as a result of that, that was the kind of like the number one reason why I stopped my trading the week prior to Thanksgiving holiday in the States. And I'm okay with being out of the marketplace for the duration of December. Now, you've seen me do some things just past year just to kind of like show what's possible, but that's not a normal thing. It doesn't happen every single year like that. And as I mentioned in previous recordings, heading up into the holidays, the calendar and the schedule that I'm going to be working with, I included then. And as we get closer to those weeks and times when I don't trade, you'll hear me talk about it again. Okay, so you know me. The sell side liquidity resting below these equal lows, and then the BISI here, buy side imbalance, sell side inefficiency that I've been eyeballing on for about a couple months now. We finally got that, but it had to get back to the 2018 high first and breaker. Okay, so we have high, low in the middle, higher high. This down close candle, that's your bearish breaker. Not this one here, this one here. This candle, bigger body candle, trades back up into it. Doesn't take the buy side liquidity. I was very surprised to see it not run through here. I thought we would punch up and grab that, and then this would be what I was expecting. But it left that pseudo equal low that was created around the Christmas holiday, and then it just slowly eroded. I guess maybe that's not the best term, is it? Didn't really do it slowly, did it? It ran aggressively to go below these equal lows and to fill up the BISI right in here. All right, so the way I defined that, I got a question about why is this level sitting right here and why is it not down here? When we had this turn here on the low and it created an up close candle, buy side was now in control. So in other words, it was offering buy side. Delivery was being given, higher prices were in order, and all through here there was some wicks, back and forth price action, and then price took off here and cleared the highest high in this cluster of candles. But more specifically, it's the highest candle high in all the up close candles. Okay, so buy side delivery was limited to here. Then we had this down close candle, which is not that big of a deal because it's inside of this down close candle. So I'm not really concerned about that in terms of the body and all that. This imbalance that creates the buy side delivery, I'm anchoring the low of that fair value gap to this high. I just don't have it drawn all the way over there to that. That's what that is. So the market goes just a little bit below that. The next day it opens, trades down a little bit, doesn't break the low, runs right back up into these equal lows again, and then closes on the low. The next day we open, trade down, and then we have a nice pump. Then it runs right back to those equal lows again. So we're in a really awkward area for price action. I would rather see it continue to go lower. Okay, it has to work out some holiday rust. But I'd like to see it continue going lower. If we do start to make a run higher, there's nothing in here that's imbalanced. Okay, this right here, even though I look at this generally sometimes, like we had the Trump election, it created something like this as well. The day he was elected, that evening. Usually I'll dismiss and not really pay too much attention to that. But in this instance, because it created equal lows and it did come back down into it, I'm having a little bit more significance placed on this wick, whereas I normally wouldn't. And I want to kind of like spend a minute explaining that. Generally, if I see a long wick candle that runs an old low, okay, or it could be done with the same thing, just reversed if it was a big wick high that ran a previous old high, I don't like to look at that and consider anything about that range at all. But because the context was this busy anyway for months now, I want to keep that in mind and not dismiss this range, because we came all the way down, ran rather shallow, stops, and then came back deeper to rebalance, and then we came back to an area of old order flow, which is these equal lows. If we run above these equal highs, the next area would be here, which is another pool of liquidity, buy side liquidity, and it would take getting above these equal highs here, relative equal highs, to me to be returning back to a bullish stance on dollar, because as of right now I'm bearish on dollar until we get below this low here and this low here, because I think the sell side liquidity resting below here is just too enticing to take that and not take it, rather. So I think, on a near term, I guess in the course of the remainder of this month, I'd like to see it try to make an attempt to get down here convincingly below this low. But again, if we trade through this and rebalance all this, I don't think that it's a setup to rebalance and then go lower. I think it's going to go up and then run the buy side liquidity and then make an attempt to get above here. But I'm just giving you a catalyst for me changing camps, because right now I'm bearish dollar. All right. Let's move on into the hourly chart for dollar. And yes, this is that Christmas holiday volume. Runs below the low and then comes right back up, touches on that 2018 high again, and then we aggressively make a run below, rebalance. This high and this low is that BISI on the daily chart. So price goes below a little bit, rams right back up into the equal lows. That's what this line is here on the daily chart. We consolidate, trade back down, doesn't get down to the low of the fair value gap or BISI, and then rallies through, finds some support at the top of the fair value gap or BISI, and then runs right back up into that equal low again. So real nice. This is what you would expect to see in classic support and resistance, but not defined in any capacity that you would find in a classic textbook of retail support and resistance. In the 15-minute time frame, again, a lot of insignificant price movement in here, but the one I want to talk to you about is in here. We have all of this imbalance at the top of the fair value gap, or BISI on the daily chart. Price comes down, nails that, and when we run higher, comes back, rebalance, and then we run to that, again, equal lows that's seen on the daily chart. Moving on over to euro dollar. This is our daily chart, and this is our old equal highs that we had buy side liquidity mapped out for that. Then we had the expectation we could run above these over here, and then we still have these relative equal highs. I like those, and then this fair value gap. Sell side liquidity resting below here, buy side liquidity resting above this high now. Price runs up into that 112, almost 112.40. Gave up the ghost, traded lower, and I left this fair value gap in here. Okay, I've been waiting to talk to you after the holidays because I wanted you to take a look at these levels in here. Now, looking at all this price action, you really couldn't see anything of any importance or any significance. But as I taught, IPTA, the interbank price delivery algorithm, will remember, okay, it remembers where these fair value gaps exist. It defines the high and the low. This is the high of the gap. This is the low of the gap. Okay, only because it's been rebalanced up to this point. Prior to that, it was here on this high. Leaving these levels intact and drawing them out in time. Okay. Remember, there's IPTA data ranges that you will learn in later months. How far back do you use fair value gaps and old PD arrays? You're going to use the maximum data range. After the highest data range, and I'm purposely not talking about everything because some of you aren't at that level. And I know some of you are getting very frustrated because when I do that, you're like, well, just tell me what you're talking about. Well, I do tell you what I'm talking about in the lesson. Okay, but when you get to that month, you'll see what it is when it's the data ranges. So if the data ranges, I had a lot of people in the first group, most of the tossers, they were complaining, oh, if the data ranges, it's just filler, there's nothing to it. They had no idea, and they still don't have any idea what I'm talking about, okay? But I'm now introducing the purpose of them, okay? And the fair value gaps in all of the PD arrays, they expire at the maximum IPTA data range, okay? I give you 3 of them, and they're very specific. But once you go to one day after the highest data range, then I don't consider the PD array. And I think it's basically expired. Okay. There's certain things I'm allowed to talk about. And this is one where I can get real close to it, but I can't go any further than what I just said. I just know that these things expire at that highest data range. Okay. And I know your head's swirling right now if you haven't gotten that far in the mentorship, but I promise you, if the data ranges are covered, it's 3 specific data ranges. I tell you how to identify them and work with them. But the fair value gap in here, this SIBI, I want you to take a look at what goes on the hourly chart. Okay, so here we have the high of the fair value gap and the low of the fair value gap. Price comes back into the fair value gap, boom, hits it. Now notice how beautiful the reaction starts from here. It really starts to run. All of this price action here is just like, it's meandering, it's going a little bit higher, going a little bit higher, back and forth, back and forth. And then when it hits this on top of an order block, when it hits this, look at the surge and clear indication that it wants to go higher all through here. This is the power of understanding IPTA and institutional order flow. You don't get that from volume profile. You don't get that from supply and demand. You don't get that from Wyckoff. You don't get that from anything else except for what I'm explaining to you here. Because the price engines that deliver price from the central bank, they have very specific generic macros that they follow. And they look back a certain number of days or months or weeks. And the one that I taught is the IPTA data range, okay? And When you understand what those three data ranges are, you know how far to look back, because I get a lot of people asking, well, how long would I consider looking at a bearish order block? When will it no longer be valid in my eyes? The answer is the maximum IPTA data range. Okay, because once it goes one day past that, I no longer consider it. I'm not interested in it, because there'll be other factors that I would use versus that as a catalyst for a trade. But look at the beautiful reaction here. It hits it and then really starts to take off. This is a signature of algorithmic price delivery. It's not random. It's absolutely controlled. It's absolutely meant to happen. It has nothing to do with buying and selling. It has nothing to do with supply and demand. It has nothing to do with profile, point of control, all that stuff, okay? There's a lot of things that other folks will talk to you about, okay, if you give them your ear, and they're going to sweet talk you into believing that these other things have something to do with why price moved. Think about what that is implying, okay? Because the camp that believes supply and demand is what makes the markets go up and down, okay? What are the factors that are attributed to supply and demand? They have to have all these little, I guess, procedures, okay, that they look at, and they can't cut through candles. No cutting through candles. It's got to be a fresh or a most recent supply or demand zone, okay? If it's Wyckoff, there's a lot of subjectivity to that. And if it is volume profile, okay, you're going to look at point of control. You're going to look at all these other things. And you're trying to tell me, in addition to Elliott wave, harmonics, price is aware of all those things. Which one's it going to follow today? Or tomorrow? Or next week? Do you really understand that that's the fallacy in all of that? And every one of these camps, and they would be looking at me the same way, like, oh, he believes this is the only way the markets move. If they were here seeing how we do this every single week, they would drop all that other stuff, and they would be doing just this. Because this is how the interbank market is delivered. When your charts are printed and painted, all the candles in there, okay, everything is already predetermined. There's nothing surprising. There's nothing, where did that come from? None of that occurs, okay? Well, let me backtrack for a second. Those environments occur around the holidays. That's the reason why I don't like to trade holidays, okay? Because all the rules go out, and there's so many variables that IPTA will use, I just cancel them out in my development. Okay, I know there's a lot of things, and if I wanted to beat myself up and drive myself crazy, I could create all kinds of new parameters and create new courses and mentorships and teach a myriad of other things. What I'm teaching you is exactly what I believe every trader wants to know, but isn't aware that it exists. So when we see these signatures like this, and it sounds like, okay, well, you're making a whole lot of nothing. When you start looking at these imbalances and keeping them on your chart for the duration of the IPTA data ranges, you'll have a greater appreciation for how much precision and how much timing and forecasting it enables you to do. When you apply all these things together with other factors, intermarket analysis, seasonal tendencies, market structure and all that, time of day, then you have time and price theory in agreement. Once you have all these factors in line, trading becomes very easy because you know what you're looking for. You know what you're waiting for. You're not just staring at the charts like I tweeted today. We don't have deer in headlights syndrome here around here. We know exactly what we're looking for. If it doesn't materialize, we don't do anything. And we don't regret why we sat there looking for something, because it may not form, and we don't force it. But after we hit this low of the fair value gap BSI on the daily chart, euro dollar really took off and exploded up into the high here. The market broke down, had a fair value gap, and the last up close candle bearish order block, it rebalances to this price point here. We have a level of distribution. We break a new low. All of this in here. We rebalance back to the fair value gap, and breaks loose again, comes back up, bearish order block, all these consecutive candles, makes the bearish order block, it rebalances, gets a little muddy in here, and then slams lower, back to the bearish order block here, and then distribution. I'm interested to see if it will want to reach lower and touch the top of the fair value gap. It's not necessary though, because if you look at what we have over here, we have this imbalance here, Abyssi. We essentially traded down to the consequent encroachment of that, and then we had that reaction here, and we ran this old high. So it's important to see how we trade next week, and we only had really one economic driver for Eurodollar, if my memory serves me correct. It's only one for Euro, so it'll be interesting to see what it does. And then a closer look on the 15-minute time frame for Eurodollar. These are all the fair value gaps and bearish order block confluences. Rebalance back into here. And then this is the one I want to talk about. That's the only thing besides that and this that's noteworthy on the 15-minute time frame is we had a relative equal highs. Again, this is a 15-minute time frame. So we had buy stops resting above that. The market surges, runs those buy stops out, and then slants back lower. So we've taken out the low between the high and the higher high to the right. So this sets the stage for a bearish breaker. If this high would have been lower than this one, and we broke lower, then this would have been a mitigation block. Okay, that's the distinction. I got a question over the holidays, and I have a note in front of me. Could I please make it again a distinction between what is a mitigation block and what is a breaker? A breaker is a run on the stops in line with order flow. A mitigation block is a high with a low between it and a lower high than the previous high. So in other words, it's a reverse of this scenario here. It would be reversed. This high would be higher than this one. So it's not running up stops. It's just they sent it higher. Usually that occurs with a fair value gap or return back to the mean threshold of a bearish order block. And then it rolls over lower. And once it breaks the low in between, if it trades back to that, then it's a mitigation block. I will trade mitigation with adding to an existing trade. I do not like to use mitigation blocks as the inception of a new trade position. And the reason why I don't like to do that is because I prefer and I side on the breaker as a stronger pattern. I'm not trying to diminish, because I know some of the folks that are in the mentorship, they have a strong affinity for the mitigation block. They, for whatever reason, they like that one. And there's nothing against those individuals that like that over the breaker. And majority of everyone in here prefer the breaker because the logic behind it resonates with a lot of traders because it flies against all of the things that they've been accustomed to and exposed to in the retail world. Mitigation is a little bit uncertain, and I share in that opinion because I don't have enough love for the pattern to enter a new trade at a mitigation block. So I will all the time consider entering a new position at a breaker because you're getting at the beginning of the next strongest part of the move. So this particular down close candle here, that's what I'm highlighting with that little arrow here, that is the actual bearish ICT breaker. The market trades back up into it here. We leave it and then touch it one more time at the bottom. This is our London open short position. This is the reason why I didn't do any chart work for Eurodollar, because to do that I have to map all this out, and there's really, I'm not teaching on Twitter mentorship. I'll talk about some things, but I'm not going to teach the mentorship. So we have a measured move, a high to the low, and it projects down here. It overshot it about 3 or 4 pips, but just do the measurements on here, and you'll see we get that same measurement here. Really nice in terms of symmetry. I watched this today again with my second oldest son. So my oldest is Cody, and the next in line is Caleb. And he is making me very, very proud. He's supposed to be coming up this weekend to see if I can teach him some more stuff. He likes the fair value gap. and he's been showing me examples. And he talked about this one as it actually happened when it traded down. He goes, Dad, isn't this a fair value gap? And would you go for this equals high, these relative equal highs here? I said, actually, yeah, that's actually one that you can do. Let's watch it. So I watched that with him today, and then I told him, I said, when we dip down in here, it's going to do another one. It spent a little bit of time in here, and he's like, well, I don't know if it's going to work, Dad. It looks like it's going to go lower, and the next candle went even lower. I said, still watch, because we have the middle of that gap, and then we have consequent encouragement hit, and then it runs to the relative equal highs. Okay, and again, back into the breaker. Extend that out in time. Boom, it completely fills it in. Top of that candle, top of that candle. So I just don't have it shaded out because I wanted to keep the context germane to this particular short for London on the 3rd. And I think that's going to be it for this. Let's move on over into British pound. And this is our daily chart. Again, these are the old highs I was talking about. We would see those by Christmas. We certainly got that. And then the relative equal highs here. Months and months ago, I told you that we would probably run those also. But at the time, we were only looking for this initially. It ran aggressively through all that. Came back down. Rebalanced. Fair value gap. Bullish order block. Hits it. Expands up. Mean threshold. Bearish order block. Balanced price range in here as well. Start to sell off, and when we go into lower time frames, I'm going to close this video with the SMT chart to show you again. I kind of like gave you a little bit on Twitter, but I want you to see a little bit more that wasn't shown on the little, I think it was a little video that I put together. Okay, so we had the market return back. We have a little bit of a fair value gap in here, bullish order block, so we could see a little bit more downside in here. If it trades back down to the fair value gap, hits the bullish order block, we're going to see if there's any sensitivity there. Again, it's January. I'm not trying to push the level of excitement for you to get involved. You certainly should be studying, but just watch the top of this candle in here up down to its open rather, and see if there's any reaction off this fair value gap order block, and then we would see, or likely see, a return back to this high. If it does, then we'll see it want to go higher than here. I didn't mention this at the time, but if you look at the dailies on Eurodollar versus the British pound here, we have lower highs here versus what we saw on the Eurodollar. So right away the market was, let me just slide back here. There's the difference. So here's the higher high in Euro on its daily chart versus the daily chart on the British pound, which is a lower. Okay, so from a higher time frame daily chart, the SMT relative strength analysis, the weaker of the two is GBP. Okay, so any longs would be best suited in Euro dollar, and shorting would be best suited for GBP USD. Sell side liquidity resting below here. And on the hourly chart, okay, we have a fair value gap in here, another fair value gap here. I only did the rectangle just to distinguish the two, because if I would have put two lines here and then two lines here, it would have been a little, at least I found that a little bit distracting. But they're just basically the same thing. The BISI here and a BISI here both being fair value gaps. Market runs up, leaving buy side liquidity here. The market breaks down. Consequent encroachment of the fair value gap, it's in here, hits it perfectly, right to the pip, not one pipette beyond. Hits it twice and then rolls down. We have a fair value gap again. It runs up into that, sells off, and eventually dips down into the top, okay, or the high of the fair value gap. So look at this candle here, and it hits it right here. Look at the sensitivity there. Now, yes, it's not a lot of movement, but nonetheless, that's 50 pips plus. It doesn't look like a whole lot, but that's 50 pips in here off of a level, how I taught you to use a fair value gap. Again, everyone out there that has ever looked at a Chris Lowry teaching, okay, they all understand, or they've been introduced to what is commonly referred to with his group, and I've used it over years, term terminology, because I didn't want to teach fair value gaps. I didn't want to do it. But he teaches the concept of filling the void. Okay, and I don't always teach that. I look for the top of the gap to act as support, okay, and the bottom of the gap to act as resistance when it comes back up into it. It doesn't have to fill it. It's better if it doesn't, a lot of times. Then that is going to be leaning heavily on context, which is a topic that's well beyond the scope and time that we have here today. But I've talked about it in the past, and we'll do obviously a whole lot more discussions in 2020. But this is how you find bread and butter type setups using fair value gaps. Okay, you're going to see setups form over and over and over again. And when you see them form with a great deal of continuity, confidence level goes through the roof, because you're not worried about rushing a trade because you know what you're looking for. I want you to take a moment and look at what you see here in this chart. Okay, obviously I've outlined several of the major salient points, but what else do you see? I want you to pause the video because I'm going to get ready to go into it. After you spent your time going through and what you think you identified, then unpause the video and then listen to what I'm going to explain. All right, so you should be able to see the market maker sell model. You have consolidation here. Now you could do the low to high here, and that could be your consolidation. I just like this one because it came back down into an order block, and then we had momentum. So that's the only reason why I did it. Now this is always very subjective, and I get the most emails about where to draw the initial box. Okay, because I can give you a lot of different variations of it. Like it could be this high here to this low here, and it would still be fine. It's a matter of personal preference and just, I guess, experience and gut feeling. There's certainly nothing wrong with using the low here to high. You could use the high to the low here and justifying it, saying this is relative equal lows, relative equal highs. So the initial consolidation for accumulation would be here, but I use this one. Okay, so market runs up, comes back down, retouches the initial consolidation, reaccumulation, smart money reversal, low risk sell, distribution, redistribution, another level distribution, then we run below for the sell side liquidity resting below here. Okay, this may be actually a larger market maker sell model that needs to pan out, and this might be the another, like this right here, this fractal. It could be here running up. This would be an area of reaccumulation, smart money reversal, low risk sell, redistribution, and then we would make an attempt to run below here and then attack the sell side liquidity here. So it may be a larger sell model in play, but right now this is what I wanted to draw your attention to, and what I was leaning on when I was outlining the examples before it happened on cable on Twitter. In 15-minute time frame for GBP, we have consequent encroachment of the fair value gap. Again, beautiful, touches it handsomely right there. And we have sell side liquidity pool resting here, and then very, very nice fair value gap pumps up into that, and then heavy distribution for a New York London close overlap for a nice sell-off, and then returns back into fair value gap and breaker. See that swing high in here? Swing high. When this market was trading lower all through here prior to this run up, this swing high stops would have been trailed just above that high. It doesn't look obvious here because it's all scrunched up, but this run here ran stops, rebalanced, ran lower, bearish breaker, trades up to the bearish breaker, down to the top of the fair value gap. And then we have that reaction in here. Again, look at this movement here. That's 50 pips. Just that right there. Off of the top of a fair value gap. Not filling a void, not doing other things, not supplying demand. It's ICT stuff. Okay, so when it hits it, institutional order flow kicks in, the price engines start spooling price on the upside, buy side is offered aggressively. Fair value gap, it fills. Mean threshold, bearish order block, that's 50 pips plus. Just using an idea that I've already taught you at great deal of detail. And finally, in closing, we have SMT here. Look at this area here inside the rectangle. Everything is completely germane to the low, a higher low in dollar, high, lower high in euro, high, higher high in British pound. So there is our SMT divergence, USDX SMT divergence, where we look at the 3 to get the major turn. Once that's done, we start looking for the market to roll over, and we start getting that here. And then we start seeing price going higher on the dollar. Dollar starts making lower lows here. Euro's making what you would expect to see, higher highs. But we don't get the higher high in GBP. So GBP becomes, even though we ran up high like this, and it looked strong, after the turn, okay, on the curve on the downside for distribution, GBP becomes the weaker. So it offers more downside, and the market heavily trades off. And then right here, the eyeball is just for my reminder to also talk about this. I didn't want to put too many of these types of things on this chart. We have a high with a lower high, we have a high, a higher high in euro, and we have a low and a lower low in dollar. This and this is what you would see in a normal traditional market, a symmetrical market. This is a cracking correlation. This should have went higher here than this high. It didn't. So as it can obviously be seen here, it didn't do that higher high. So that's a cracking correlation, and it's a sell signal for GBP. And you can see obviously we rolled over pretty aggressively for British pound versus the dollar. All right, so that's going to be it for this first installment of the ICT mentorship commentary. I promise as we get into February, it'll be a little bit more exciting. Right now, you just got to let the market sort its business out and digest what we've done over the holidays and what's now staring at us on the horizon. We have potential war scenario with Iran, and that won't just be with Iran. Other players will be involved. As we get into that, if it starts to develop, I'll give you my opinion on what may not transpire. And then obviously we have the impeachment circus going on. So there's a lot of things to be monitoring in the coming months in 2020. And it's also an election year too. So it's a lot of things that's going to create a potential storm for volatility, which I am welcoming. I want to see it, because if we get a lot of volatility, we are going to see some incredible analysis concepts and things panning out to script. But even if it doesn't, we still will have setups we can take, and we'll just have to be flexible and allow what the market's going to give us and roll with that. I will catch up with you all by midweek review next Wednesday. Enjoy your weekend, be safe, and I'll talk to you then or earlier by way of Twitter.